it's potentially a lose-lose, meaning we might have reached the end game of this Fed buttressing stock market prices, which really started on the crash in 1987. And that's, for me, what gold is telling me. And that's, to me, what we're seeing on divergence. We're seeing so much divergent weakness in many of the risk assets, particularly things like Bitcoin this year, compared to gold. What was one cryptocurrency in 2009 is now over 21 million listed on coinmarketcap.com. So maybe most of them aren't relevant, but the point is there's massive hubris, speculation, and excessiveness in the space, and they've become from what was Bitcoin, just definable diminishing demand, digital gold, moving up and gaining some dominance in the world, to what is now a plethora of just massive amount of speculative commodities that don't even track anything. They're numbers on a screen. That's my point. It is a third world war. People are picking their sides. Obviously, we have the Russia, China, India, not India, North Korea, and Iran. But what's happened to Iran lately? They've been somewhat suppressed. U.S. at will, and their airspace has been taken over. At will was able to bomb them. So that's kind of pushed out. North Korea has already lost, but I heard 10,000 troops or so in the war. They're kind of having a problem. Russia's lost Syria. I mean, it seems like it's tilting that way. So I'm worried about the animal getting caught in a corner. What might happen? Now, that's the risk. But from a commodity market standpoint, gold might be figuring it out. I still expect gold to continue to outperform the stock market. On a total return basis, historically, if you take the S&P 500 total return divided by gold, it always goes up. So that stopped happening far as in 1997. Since then, if you've owned gold versus a total return S&P 500, you've flatlined. So what I'm concerned with what that means, the bottom line is, it's the complete, utter, unprecedented dependence on risk assets that are the most expensive in history to keep going up, to keep the system inflated, to keep it going, that I think will lead to that next recession, deflationary recession. And fully expect the Fed to ease a lot in that environment, but I expect them to chase it. I'm glad you went, and I really enjoy speaking to you. First, let's put that 37 trillion in context. The U.S. stock market cap is 70 trillion. I love doing that when people worry about U.S. debt. I mean, compared to our stock market cap, it's almost a half. It's near the lowest in history versus stock market cap. So what's the problem? What's the sore thumb? U.S. stock market cap. So cash at least gives you 4.5% in a money market. And here's the thing. The total money market assets in this country are around $7 trillion. People use that metric and say, oh, how high cash is as a relative to the stock market cap. That's 10%. In 2009, before the great crash, it was closer to 15%. So putting that in context. So now that's a key thing. I'm glad you mentioned the question, but we have to put it in context. The beta for the whole world and for the country is Florida, and Miami is peak, and everything's rolling over. It's slowing down, I mean, as you'd expect, but it's the complete cycle. I mean, we just threw money at people, made them stay home. So what they do, they fix their homes and bought homes during COVID. And now we're getting towards this cycle. So condos in Miami are rolling over, real estate's rolling over. It's becoming much more of a buyer's market. And we're overdue for that to last for a long time and stay that way.
I'm your host, Fazan Irani. Let's connect the dots. Our guest today is Mike McGLONE, Senior Commodity Strategist for Bloomberg Intelligence, driving the Commodity Dashboard, BICOMD. Welcome, Mike. It's a pleasure to have you on our show.
Hello, Farzan. Thanks for having me. That's, I appreciate that. On the Bloomberg Intelligence, that's the dashboard I write to. And it's a pleasure meeting you. It's a pleasure to speak to you.
Thank you. My audience might not know you. I've been following you for quite a while, obviously Bloomberg Intelligence on LinkedIn, and some of the charts and the reports you put out are just outstanding. So I thought I'll get you on the show to get our audience to understand who Mike is and what you do and what is your view of the future. But before we get into all of that, if you don't mind, I generally start off with the audience getting to know you as a person. So in your own words, could you tell us a bit about your background and how you got started in the financial markets?
I guess the foundation for what you see in my writing comes from where I started in trading, Chicago Board of Trade in 1988, working the night session, covering Japanese clients. And so I was just part of that bubble that burst. So it's kind of in my blood. I started in the bond pit. So bond futures, US bond futures are in my blood. Came to New York in 93, over-the-counter options trader. Been and moved to Miami in 2021. I started with Bloomberg about 10 years ago. A lot in between. I've been buy side, sell side, hedge fund trader. And I had a former boss tell me once, Mike, you say a lot better than you do it. So, with respect to all our listeners and viewers, I'm just a sayer. Most of them are doers. And I'm going to express my views as I publish them on the terminal. And I appreciate having the conversation with you to bring them out.
Yeah, thank you. Thank you. So before we get into any nitty-gritty stuff, I just want to get a big picture view of what you see in the world, Mike, and what's your overarching macro thesis, let's say. How do you see things playing out over the next few years? Let's say the next 3 to 5 years.
Right now, I start with the beginning of the year. I stuck with gold and Treasury bonds. I think is the best positions for this year. They're mostly risk off, and the Treasury bonds haven't really kicked in. Yields have dropped, not a lot, but gold is having the best year since 1979, up 44%. To put that year in context, I was a teenager in Chicago pumping gas at my uncle's gas station, gas jockey. And that was the first time in the US we had to shift the price in a gallon of gasoline to half gallons because none of the analog um, um, pumps were configured for to go over a buck. And so it struck me pretty well what happens when there's geopolitical events. That's when there was Iranian Revolution, and you have things with crude oil and stuff that really matters. But that is how significant what's happening in gold this year. It's really got me scared that gold, to me, the quote unquote, is very scary what it might be signaling. Um, virtually every asset is falling versus gold, and that's never a good sign. And I'm afraid that as we enter the fourth quarter of this year, it's going to give us some major signals that will solidify gold's rally this year. So let's put it this way. If the stock market in US volatility stays really low, 60-day volatility right now is 8.9%. That's the lowest since the start of 2020. So that's 5 years and right before this COVID crisis as we head towards a volatile time of year. If stock market stays strong and volatility low, and that would probably keep interest rates in the US high because it's creating a significant amount of inflation, that wealth effect, then there's might be a pressure factor on gold. But if we get a little bit of normalization in volatility, it'll kick into my main theme. And my main macro theme is that we're way overdue for a little bit of deflation from the inflation, particularly in the US. So if you look at the US, it's all about massively inflated assets. Stock market cap to GDP at 2.3 times is the highest in about 100 years. Stock market capitalization of the US versus the rest of the world is, at least a few months ago, was the highest in our database going back 56 years. Now that's US risk asset inflation juxtaposed to the exact opposite, deflation in China. So we have PPI in China running minus 2.9%. We have that 10-year note yield at 1.89% versus, as we speak on Friday, September 16 versus 4.18% in the US. That's despite the fact that money supply in China is running 2 times what it is in the US, massive pumping of fiscal stimulus. And debt to GDP, by some estimates, Goldman Sachs is around 300%. Massive fiscal monetary stimulus in that country. Despite that, you're seeing normal deflationary forces of of an emerging market that's just expanded too fast, i.e., Japan in 1989, and then it's going to a deflationary period. So all this is coming to fruition, I think, and gold is figuring it out that there's a risk that the U.S. stock market might normalize a little bit. And then when gold typically performs best on a global basis in inflating periods, particularly when a currency is debasing, and in deflating periods, i.e., what happened after 2008 in the US. Now, obviously, I'm speaking from a US standpoint, dollar-based standpoint. From the rest of the world, it's depends on their currency. So to me, that's the macro that's kicking in, and my signals are for that, for is gold going up a lot this year and crude oil going down. It was a lot for a while, but still, hovering around $65 a barrel in WTI. That's last year's low, but the trends are down. Even the grains, the trends are down. And I'm worried that I'll end with this. We just started a Federal Reserve easing cycle. And the consensus is, oh, the Fed's easing, stock market goes up. What? Pound my fist. No, that's not right. It usually doesn't work that way. Just remember the key points in history. When we started cutting rates in January, the first session of January 2001, The S&P 500 dropped about 45% from that level. Obviously, we tilted towards a recession, and 9/11 was in there. When we started cutting rates in September of 2007, the S&P 500 initially rallied like we did this time, and then dropped 55%, maybe even a little more, as we tilted towards recession. So I think what's happening now is the world's facing a discombobulating president who's pushing back in 50 years of world order, pushing back in the rest of the world exporting to the U.S., pushing back in the Federal Reserve, some of that stuff that really made America's stock market valuation really high. And there's a risk it could tilt lower. And I think fourth quarter is going to be very telling.
This is a good point you made out there, Mike. Obviously, gold's making new highs in the US dollar now, but it was already making new highs in most of the other currencies. And as you said, gold is sniffing something up because most of the other currencies were already moving towards stagflation or deflation. Most of the other economies, it was only USA that was holding it up. So most central banks have been dropping interest rates, and the U.S. Federal Reserve has just come to the party. While beyond that, do you think the Fed made the right move by cutting interest rates, or was it just political pressure that's actually made him do that?
It seems in this case a little more the latter. And that's unfortunate because it's just kind of an oxymoron for someone who's been a Fed watcher for almost 4 decades. I've just never seen this. The rule I learned in the trading pitch is the Fed is there to take away the punch bowl when it needs to be taken away and then help save us when it needs to be saved. They mentioned one book, The Courage to Act by Ben Bernanke. He just pointed out how the Fed really did a lot of things that really helped save us from a pretty significant depression and during the great financial crisis. So that's an old one, but now it's different. Now we have U.S. stock market cap to GDP running 2.3 times, the most in 100 years. So it's way elevated. Um, and the Fed's easing. And, we also have things like cryptocurrencies just taking off massive excessive speculation. And the Fed easing in that environment is kind of an oxymoron. And the consensus, it's going to just help lift that tide for everybody. And I'm worried that maybe this is going to be the signal that we're near the end game, because just what happened when they first started easing last year around this time is bond yields started going up. And again, this time, the 10-year note yield bottomed about 4% right around the Fed ease on September 17th. Right now, it's almost 4.20. Same thing with Fed funds in 1 year. I love to watch. That's always where Fed funds will be in 1 year. September Fed funds of 2026 bottom. They were around 3% when the Fed first eased a couple weeks ago, and now they're up around about 3.2%. So they're showing that, okay, if the Fed's going to ease and keep risk assets elevated and keep that wealth creation effect that most in 100 years higher, then it's going to create more inflation and take the Fed out of the picture. And it's potentially a lose-lose, meaning we might have reached the end game of this Fed buttressing stock market prices, which really started on the crash in 1987. And that's for me what gold is telling me. And that's to me what we're seeing when divergence, we're seeing so much divergent weakness in many of the risk assets, particularly things like Bitcoin this year compared to gold.
Yeah, yeah. We go to the gold, we go to the Bitcoin. I just want to ask you one thing. My opinion on the Federal Reserve or any central bank, I always ask some of the people I interview, do you think they're firefighters or arsonists? What is your quick view on that? I'm just being honest.
I think definitely firefighters. That's the purpose of the Fed, to be in there. As J.P. Morgan was before the Fed was established in 1913. This was the panics before that. They kind of help save the market when it gets flushed out. To be there and save us in major capitalistic collapses, which happens in capitalism. That's just the way the cycle works. But they've tilted a lot to that. Now they're just getting a little bit extreme. In this case, like I said, Ben Bernanke really proved that during the great financial crisis. But now it's just we're tilting towards they've created way too much excesses in market valuations. And I so appreciated when Chairman Powell's recent speech, at least he finally mentioned that. They hinted at it. I mean, let's talk about the elephant in the room for everything. When people talk about consumer spending and inflation and consumer sentiment, the elephant, the 10 on a 10 is U.S. stock market at 2 times GDP. It's never been this high. The average human on the planet has never been more exposed to U.S. stock market. And the average human in the U.S. has never been more exposed to the U.S. stock market. And it's due for a little bit of normalization. That's why I worried when you get 60-day volatility down to a 5-year low, you're supposed to be looking as an ex-trader. You're supposed to be looking at positive gamma, negative delta type positions on risk assets. The thing is, they're all the same now. The correlation between Bitcoin and cryptocurrencies and the S&P 500 on a 48-month basis, which is that 4-year cycle, is the most ever. I mean, it's almost 0.6. To put that in context, Bitcoin's correlation to the S&P 500 at the start of 2020 was minus 0.05. So everything's so much more correlated. Everything's connected. And I like to say, if you're buying a put on Bitcoin or on a yield on the long bond or the S&P 500 or even crude oil or copper, they're all the same, particularly if beta drops a little bit.
Okay. Let's go towards Bitcoin, because I've heard you comment on that. I think Bitcoin mirrors a lot of the Nasdaq. It is a speculative asset. That's my personal view on that. What's your view? Because I've heard you once in the past. Obviously, previously you were the only one when it was sitting at about 10,000 to say it would go to about 100-ish. And now I don't want to take away your punchline. Tell us where you think it's going now. First, the logic of why at 10 you thought it would go to 100, and now what's your reasoning behind the next move?
I so appreciate that question because I did get that one right. I have to admit, and some of our viewers and listeners might point out, yes, I did waver partly after ETFs were launched. It got to 75,000. I started kind of giving up on it, but it did happen. And I rode most of it the way there. And I was at the University of Miami this week, and a student asked me the same question. I had to point out at that time, the key thing you learn in being a strategist, you always want to look for an asset. To remember, you should be selling when they're yelling, which is what I see right now in most risk assets. They should be buying when they're crying. 2010 and 2020, I'm sorry, when Bitcoin was around 10,000, they were significant crying in this space. And I saw what was happening. First of all, the Trump administration hated it, yet it organically went for the dollar. I always like to point out the most enduring part of this technology is the proliferation of crypto dollars. People call them stablecoins, but that's a pressure on the rest of the world's currency. It just happened organically. Seeing that happen, and then the key facts about Bitcoin: it had some major utility, definable diminishing supply, and increasing demand and adoption. Poof. What's happened since? The Trump administration is flipped. It's gone to 100,000. And what was one cryptocurrency in 2009 is now over 21 million listed on coinmarketcap.com. So maybe most of them aren't relevant, but the point is there's massive hubris, speculation, and excessiveness in the space. And they become from what was Bitcoin, just definable diminishing demand, digital gold, moving up and gaining some dominance in the world, to what is now a plethora of just massive amount of speculative commodities that don't even track anything. They're numbers on the screen. Now, remember, that's what I come from. I come from a background of numbers on the screen, but they all have a basis. Every commodity you trade has a basis. Its basis, you trade corn, crude oil, gold, everything is a basis in an underlying physical asset. The only cryptos that have a basis are crypto dollars, stable coins. It's about 300 billion. Now, that other 4 trillion are just numbers on the screen. And I think they are the pinnacle. They were part of this massive inflation that started after the US financial crisis when we just pumped too much money in the system that doubled down in 2020. And now at levels where you're supposed to be looking for them as a leading indicator. And I think they led on the way up and they're going to lead on the way down. So I'll end with this. There's one thing I really like to point out. As you look at number 8 cryptocurrency, it's Dogecoin. It was launched as a joke. It cost nothing to launch. It's $34 trillion. Billion dollars. And that's at some point that's going to go to zero. It just needs an inflection point. And I think it's going to happen when US stock market goes down 20% and stays down. Stuff that used to be normal.
Do you think what's taking these, as you said, the Dogecoin and the shit coins and all of that stuff, what's taking it to these stupid levels? Is it just too much liquidity in the system, or is it just a gambling casino mentality that's come about?
All the above. It's very much like a 1929 situation in the U.S. It piles on itself, maybe a little bit, but 1987 before the crash, certainly like 1999, and very much like 1989 in Japan. I mentioned 1929 in U.S., 1989 in Japan, because there are only 2 relevant examples in history when you got a stock market capitalization GDP over 2 times the GDP, and then we saw what happened. Now, maybe it's different this time, and I'd love to get pushback on that because I don't know of any other relevant examples. Now, I heard in China was somewhat similar, but the data in my terminal doesn't say it was that expensive. I heard people say that, but sure, it was expensive and then just corrected. But it's the whole trickle up that way. It all started after the financial crisis. But I think what happened when Satoshi Nakamoto created Bitcoin, he created a very relevant digital gold. But now humans will do what humans do and have just like abused these assets, and it's great. It's just a giant casino. So I like to, I'm from a trading environment, trade it. It's wonderful to trade, but it's way overdue for a purge, a big purge. And I think when people in this space are missing is you go through cycles in markets. But now, so before Bitcoin would go up and volatility would go up on a big, as the asset matured, but now it's almost very much matured. Its correlation to the stock market is the highest ever. I go by 48 months because that's 4-year cycle, about 0.6. And the big difference now is they're completely in the space. You can buy anything or sell anything you want in ETF and in futures, and the best days are over. But also in that space, or in this pylon, like I say, we're in a sound what you're yelling phase, like things like we're seeing from the quote, the two words, Bitcoin and Treasury, or cryptocurrencies and Treasury, in the same sentence is a complete oxymoron. I think of Treasuries, and just a few weeks ago, I was able to buy long bonds at 5%, locked in for 30 years. I'll take that 5%, particularly as I think we're going to deflation. But that to me is, I think we're getting that pile-on effect. People all want to do what Strategy did, Michael Saylor. And, it's one of those examples you should be selling when you're young. So to me, it's just massive speculation. I did jump on board for a while. Now my outlook is, hey, I'll repeat what I said in 2018. Bitcoin went to 17 on its way down around 10,000. I said it was going to lose a zero, which implied 1,000. It got down to 3,000. So I was wrong. I only got 70% of that trade. But it's a key lesson to learn in trading is if you have a bell curve, if you can get that 2/3 in the middle, the majority of the bell curve, you're doing great. Try to get those kurtosis ends. Good luck. So I'm making the same call. I think it's going to lose a zero. I think the key catalyst with that might happen in the fourth quarter with the U.S. stock market going down. And my base case is, I'll stick with it, particularly signals I'm getting from gold, is that the U.S. stock market's overdue for another 50% drawdown. That would be only the third since 2000, since the beginning of the millennium. And I don't, it's not really profound to say that, but when you say it, people look at you like you have three heads, then you're touching something because it's so expensive. But, maybe it'll stay this way. But that recession that we haven't had for 2 years would be wonderful. We don't get it. But the number one force to shut off consumer spending is to have the stock market go down, unfortunately. We're just the most dependent in our lifetimes.
Yeah, fair enough. You make that point. My belief on Bitcoin, firstly, was I don't even know Satoshi Nakamoto is a real human because I think I've read white papers where I believe it's come out of the NSA or the CIA to get people used to something like this during the global financial crisis. That's just my opinion. And as you said, I thought it was always, okay, it's trading vehicle. Other than that, yes, if you have to jump ship from one country to the other, okay, it's useful. But other than that, it has no material value. There's nothing underpinning it. As you said, commodities, at least you got a gold, you got a grades, you got something tangible, touch, feel, drop it on your foot, and it bloody hurts, right? Bitcoin is this magical, and they mimic it to a gold coin anyway. So I don't want to even go there. Your view on the deflation you said, I'd like to get more of your views on that because obviously, as you also touched, that the U.S. economy hasn't hit into a recession. I thought even the U.S. economy has gone into a stagflationary period already, even though the numbers are not showing it. What's your view on that with the whole deflation thing? Is it a short-term deflation shock, or is it more a prolonged deflation?
I think it's a simplistic cycle that will be worthy of the inflation that we got to the peak in 2022. To mention another book, The Price of Time by Edward Chancellor, just points out those cycles always happen in history, had a little focus on China. Another book was The Boom and Bust by Quinn. There's a few of those. Just points out how cycles always work that way. And I prove it on the terminal. I just mentioned a few of them. What happened after 1929 in the US, what happened after 1989 in Japan, and even in 1990 in the US, 1999, what happened after that, what happened after 2008 and 2007 in the US. You have deflation that follows inflation. And the key thing is the mindset is people are buying some of these speculative assets and thinking that, they have the recency bias. It's human nature. Like, oh, wow, I'm going to get more inflation. Then they should be focusing on the other risk, which is going down. And number one force for all that on a 1 to 10 basis is the 10. The 10 is the U.S. stock market. Everything else is maybe a 5 or below. It's just that extreme. Like I said, we're seeing pretty severe deflationary forces in China. Their stock market's being held up because the government's buying ETFs, just like Japan started, 15 years ago. It got up to a new high, and they're starting to sell now. But government has to do that. And they're facing a paradigm shift with the U.S. cutting them off, and they're exporting their deflation to the rest of the world. I'm not saying it's bad. It's just a cycle that we're in. And like I said, fourth quarter U.S., McGLONE might get stopped out of this view, and it might really just accelerate my view. So my view is that volatility in the U.S. will recover from this 5-year low. It's only 60 days, a good signal. This is a short-term signal, and it'll start trickling down, and we'll see it happening. And the key reason I see it, and things that really is telling me this is I'm going to be right. It's what's happening in things like the world's most significant commodity, crude oil going down, and the ancient store value, gold going up.
It's good you said that, because the whole deflationary thing is generally people say gold leads the way is a signal to tell you there's a commodity bull market coming. But again, your point is exactly quite different, because it's not all commodities going up. There's only certain commodities going up because things like oil and copper would actually be booming if an economy is showing signs of inflation or growth. That's your entire point, right?
Yeah, well, I like to point out the Bloomberg Commodity Index is up about 9% this year, but the vast majority of that is being driven by gold. Gold is the biggest portion in that, and gold's at 44%. Okay, that's not a good sign. Crude oil's down, and all the grains are down. The most elastic commodities on the planet are the grains: corn, soybeans, and wheat. I used to own a farm in the Midwest, and I just had a good sense for that, having picked my fair share of corn, cut my fair share of beans. Um, but that's the essence of all. And the cycle right now is downward. Why? Because it's the deflation after inflation. The main reason the highly elastic commodities, the grains, and even crude oil is going down a lot of that's because of the technology revolution, is because they went up too much at the peak in 2022. You spike too high, it brings on that excess of supply, just decentralized demand. You can even cause supply issues with economics. And right now they're heading towards that low price cure. The question is, how low does it get? Now, crude oil is going to have bounces, but I don't think typically, if you look at the lessons of history, typically the last 20 years, it's bottom around $40 a barrel. Here we are at 65. 65 was last year's low. Okay, so it's bouncing. It's having some geopolitical issues. I think traders are looking for those rallies to sell. So I think next year is going to shift. And the key thing that's holding it up is that U.S. stock market. Even the grains, look at the price of corn, the most significant agriculture commodity on the planet. Right now, it's about $4.21. That price was first traded in 1974. The high was 8, and the bottom's usually been around 3 or so the last few years. We just create more with less every day, and that's the key thing I hear every time I go to agriculture conferences. Is some of the people in the space say, "Mike, I just can't keep up with the technology, particularly the seeds." Now the rest of the world's adopting that, particularly in China, maybe in India too. I hear, but why not? I mean, you can see this. People are doing it. We can do it too. So to me, that's that technology deflationary force. And I'll mention that from the book, The Price of Tomorrow by Jeff Booth. He pointed out the significant deflationary forces of rapidly advancing technology. Energy is being replaced by technology. I mean, my EV is 11 years old. I put solar panels in my house in the US with subsidies 11 years ago. The thing is, I locked in the price of electricity at that day forever. Okay, so they decay after 30 years, but it's overwhelming. Now, our president is really pushing back on a little bit, but that's okay. He pushed back on cryptos and then he tilted. He'll realize that eventually that's entertaining him about the American system. We go through cycles. The good news is we're the most significant self-correcting mechanism ever. We figured out we're doing something wrong. We'll go the other way and either way. But to me, that's the deflationary forces to remember. And you're supposed to focus on inflation when you have risk assets, the most expensive. I guess I don't like to say ever, but would say a century. That's when you have to worry about what might change. And that's why I say this is not where you're supposed to overweight risk assets. And gold's telling us that. Now, gold, like people might say, goes up in inflationary environments, but yeah, it does if your currency is being debased, but it also goes up a lot in deflationary environments. And that's what happens when crude oil goes down.
Yeah, gold actually, I've heard a lot of market commentators saying gold is kind of a symbol that there's too much, well, where inflation is going up, but I think it just keeps up with inflation over years. I think gold is more geopolitical or loss of faith in government kind of an asset, where it tells you something's not right, something's about to break somewhere, and that's when gold goes up. Having mentioned that, because if you're saying deflation, let's say, what are your views on the whole geopolitical environment we're in? Because I believed, I believe we're going to World War III. I get interviewed on a show in New Zealand called Money Talks, and I've been telling them for a year and a half, we've already entered World War III. What are your views on it? If we go into a war, whether it's the Middle East or Ukraine or Russia, does that affect commodities? And does that war is generally inflationary, right? So is that their way out of this, or?
They used to be. I enjoyed that from people who did not understand what happened when crude oil pumped up to $130 when Russia invaded Ukraine, did not understand what that meant on a global basis. It means like the most significant energy producer, net exporter in the world, just incentivize that more supply and shut down demand. Now we're still heading lower, but the thing is, we are in a bit of a third world war, but it's a modern war. It's economic. There's another book I can mention, Choke Points. I've been listening to this one. Most of them I listened to. The author was Edward Fishman, pointing out how everything is so economic. And let's point out one key fact. Here's my view on this. We have a significant war in the Ukraine right now. And other than Vladimir Putin, there's one person on the planet who can end it with one phone call. Vlad, it's Z. I'm kind of done with this. I'm sick of supporting you and being the decisive enabler of your war, according to NATO. It's not my quote. You could end it in a heartbeat. That's a sign of a Cold War. Yet China's biggest customers are Europe and the US. And Mr. Z's pushed back on his best customers, like decisively enabling a war in their backyard. I mean, okay, well, that sounds pretty silly. So to me, it depends. And just hopefully it doesn't get nuclear. That obviously is bad for everything. That would mean two key things: gold and a curve steepener. Everything else is somewhat and I don't know what else would happen, but the two key things. So hopefully that doesn't happen. But we're at the stage now that what's happening. My next key thing, what's happening in Ukraine, is just what Trump said lately. Since he did try to push détente and Mr. Putin. Now this is all what I hear from the strategist, and it's not working. So now he's suggesting things like, well, okay, well, maybe Ukraine should take back their land, which implies there might be some help there. And that might may push things to get very much scary. So even what's happening in the Middle East is very scary. But the point is they're so far isolated. But what they did, these initial things, is the initial rally pumped up all commodity prices, and now we're in that deflationary cycle from that pump. Things have to get decisively worse. There has to be a major cutback in supplies, but we're finding out that certainly in this country we have a massive excess of energy. Got to export it. LNG, grains, crude oil, you got to export it or prices will go down. Same way, they're just a massive export surplus, and certainly from a U.S. standpoint. That wasn't the case in history. In the grains it was, but certainly not in energy. But so that's my point. It is a third world war. People are picking their sides. Obviously, we have the Russia, China, India, not India, North Korea, and Iran. But what's happened to Iran lately? They've been somewhat suppressed. U.S. at will, and their airspace has been taken over. At will was able to bomb them. So that's kind of pushed out. North Korea has already lost, but I heard 10,000 troops or so in the war. They're kind of having a problem. Russia's lost Syria. I mean, it seems like it's tilting that way. So I'm worried about the animal getting caught in a corner. What might happen? Now, that's the risk. But from a commodity market standpoint, gold might be figuring it out. But it's still the cycle that the initial invasion started, that cycle towards the inflation that leads to deflation. And right now we're in that inflationary cycle. So this is another thing. One of the students asked me at the University of Miami, should I short crude? I was like, well, I'm still bearish. My call was for 42 years ago. I've been early, been considered an idiot for a while, but that's what you have to do in commodities. You look for cycles. But now it's kind of at this stage. If I were to short it as an ex-trader, it'll go up, stop me out, and then go down. So you have to wait for rallies to sell. And I think that's what was happening in all those commodities. So I knew you asked, because you've traded before. You see how this happens. You have to be opportunistic. So the way I see all these commodities, like they're all in the same bucket. Crude oil and the grains, they're going down to that low price cure. They have to get below the cost of production historically and stay there to shut off these excesses of supply. In the US, that's about $55 a barrel. The low this year is $55 a barrel. So at 65 now, what does that mean? That supply is going to keep coming up. In corn, that's just below about $3.70. That's about this year's low. So the initial bounces are happening. The key thing is the next thing is what makes them stay below. And that's why I tilt over to the U.S. stock market and volatility being that low. You just get a little turn down in the stock market. What's up 14% this year? Let's see if that turns that down to just a 5% rally. That's a severe deflationary forces. And copper is the number one I'm worried about, because on a year now, the U.S. traded copper. I have to focus on U.S. traded because it's been the center of the world universe in terms of tariffs. Pumped up 40%. Right now, it's about $3.76 a year, but it's locked right in with the performance of the S&P 500. S&P 500 is about 14% on the year. Copper's up about 17%. They're right the same chart. So my thought is this economically sensitive metal that's kind of stuck in the middle and recently got pumped up by some mining disruptions in Indonesia needs the stock market to go up. It absolutely has to have the stock market to go up, or it's going to go down back below $4 a pound. Now, I have to use that U.S. dollar price because copper and rest of the world, London's locked in at 10, but it's less significant now because the center right now for copper is what's happening in the U.S.
That's why they call it Dr. Copper, don't they? Because
Yeah, yeah.
it's kind of provides a symbol of what is happening in the economy. So you think copper is showing signs of everything slowing down and deflationary input coming in. Your views on, let's say, because you're talking about copper and commodities and oil, so don't you think if this war extended with Iran and Israel again and the Strait of Hormuz shutting down, don't you think that could spike it up again?
I love that. That's a quote that I hear a lot from people who justify their long positions in crude oil. They say if. It's never happened. Okay, so that's a pretty low probability. Sure, could happen. And that'll stop out shorts. It'll pump up the price. It'll incentivize more production, shut down the world, put the world into recession, and eventually go back down. The question is how high it goes. It's if that happens. The question is how it happens. It'll mobilize the world against whoever shuts it down too. That's what would happen if Russia starts using nukes. I mean, just the whole world will push against it. Just they might cause a lot of destruction in the meantime. So I love that if statement because it's not working. And obviously, I've been called a notable crude oil bull bear, partly because I had to get thrown down on the mat for about a year, just pointing out when it rallied to that peak in 2020. It's just how commodities work. If I was a trader, I would have been stopped out, but I got stopped out early in 2008 as a trader and then made it all back on the way back down because I just saw what happens. Crude oil is the thing. It's shifting now. It's the world's changing. Just what did that incentivize now? Just fact that you can get a BYD electric car that's almost twice as efficient as a Tesla and half the price. It just can't pass up this technology. And that's just one. There's 100 automotive manufacturers in China. And the government now has to have major rules to push back on the deflation and competition they're forcing. It's the example that Scott Besant used of the broomsticks in Fantasia, the movie. Now, we probably might remember this, but it was from The Sorcerer's Apprentice when Mickey Mouse does the spell and he forgets how to stop it, how the broomsticks just keep proliferating. It's right now, that's a severe deflationary force centered in China, but most notably in energy and renewables and storage and things like that. And the U.S. has to have tariffs on it because to protect their own industries. But what's going to happen with technology? They got to catch up.
Yeah. You mentioned tariffs in there. Do you think so? So your viewpoint is the stock market is going to come off by a little bit, not a come off by a little bit, or a major crash? Or what is your viewpoint on that? Because it is getting frothy. Everyone's buying the dip mentality just keeps getting in, right?
Yeah, so that's such a known how frothy it is, and people have heard this from before. Yes, McGLONE's been wrong, but I haven't been wrong about gold outperforming. I still expect gold to continue to outperform the stock market on a total return basis. Historically, if you take the S&P 500 total return divided by gold, it always goes up. That stopped happening far as in 1997. Since then, if you've owned gold versus a total return S&P 500, you've flatlined. So what I'm concerned with what that means, and the key thing is right now is as I'm looking at fourth quarter, looking at 60-day volatility, S&P 500 dropped to a 5-year low. I said there's certain times as a trader you say, yeah, I'll take a little risk on some long I'm sorry, long gamma short delta positions, which means puts. Now, I'm not a trader, but I think that's what the market's thinking. But they're all the same. You can choose Bitcoin because it'll probably go down the months, or maybe Ethereum, or maybe a Bloomberg Galaxy crypto index. They're all the same. You can choose copper. I mean, that's just how we are now. And we all know if beta drops, everything falls with it. So that's my point. It's the most risky time ever. And gold's telling us you're supposed to be underweight and just waiting for opportunities. And that's why I look at Bitcoin as a key indicator. It looks like it's going to at least go back to 100,000. To me, that was the key threshold. And looks like the VIX, as we speak, it's 15. I mean, it's very low. The low for the year is 14. That was in August. At the same time, the VIX, and the Bitcoin made a new high. See that the inverse and trading there. So the 200-day moving average in the VIX is just below 20. I think it's at least before then you're going to get a chance to sell it around 20, which is probably the first time you're supposed to do that. I think you're going to get a chance to buy Bitcoin in 5 figures, just below 100,000. The first move, you're probably supposed to do that. It's what happens afterwards. If my base case kicks in, which, as I mentioned, I think we're overdue for a down year in the stock market. That means Bitcoin could easily start dripping below 100,000 and the VIX stay above 20. If that happens as we tilt towards the end of the year, see what that means for next year? It's a really bad sign. That's my point, is when you're at the point in a career in a markets where the stock market absolutely has to go up. I mean, it has to. It's part of everybody's outlooks now that, they just assume it's going to be up 10%. Then you know that you're at near an end game. And I think maybe it's going to happen like when the Fed first started cutting rates in 2007 and 2001. It was time to sell stocks.
Yeah, but some market commentators actually say the US government and the Federal Reserve, in a way, kind of needs the US stock markets to keep going up because of the amount of the tax take that comes off that alone. And I think I mentioned, I think I've heard you once also say there's only 10% of the US population that owns 80% of the stock. So if that comes on, there's again a wealth effect coming off. Do you want to talk around that case? Like, how does that affect the mentality of the average person in the
That's a
US?
quote I've heard numerous different sources. I think it's pretty reliable. I would not take credit for it. I have to say, just like some of the other things I say, it's, I use what I know is true, and I hear people say it. So that's a fact. About 10% of the population owns about 80% of stocks. I even think Scott Besson said that. But the bottom line is everybody's exposed more than ever. More than ever because of things like 401ks and stock programs and everything. But the key thing to remember is about 55% of this country are wage earners, and they're having a hard time. Um, and you can see that in things like corrugated boxes, and certainly with shipping. You know, truck and shipping is all kind of in depressing markets, and in like um, auto loan defaults kicking in. But that to me is why I think it's such a simplistic thing. It's not really digging in the details too much. When you're at 2.3 times GDP, total stock market cap, it is the economy. When the stock market gets that high, it becomes the economy. Like I said, the most recent example in history is 1989 in Japan. And that was an emerging market that did not support was not a decisive enabler of a war in its neighbor's backyard. You see how unique this situation is now. It's just how long can U.S. remain this elevated in risk assets, this expensive, particularly as we get a very discombobulating new government that thinks they know everything. And Mr. Trump said he's always right about everything. So that's usually, how that works in history. When you have that kind of hubris, usually you get your modesty will unfortunately come on and smack you once in a while. That's just how history works.
But obviously, Mr. Trump, obviously, he's been a real estate developer and he loves debt, right? And he's seen the country's in $37 trillion debt. The country's barely servicing its debt, and obviously the long end of the yield curve, the interest rates were going up quite a lot, even though the Federal Reserve was dropping interest rates. So he wants cheaper interest rates to service the debt. But where does that leave, let's say, the Treasury in the short or the long term? Because they were issuing debt at the short term because they couldn't sell the long term. You think now because of the share market dropping and geopolitical events, people will go to the long term of the yield curve?
Oh, well, I think it's been one of my base trades that I've been wrong on for 2 years, Farzan, and I have to admit that. And it's one of the markets I thought I know best. That's why I started in the business and helped me get out of the pits and come to New York and be a trader. It's just getting the long bond right. And I've been wrong for 2 years. But the number one reason I've been wrong is because I haven't seen that definable, 20% correction in the US stock market that stays down. That's the number one thing pumping up inflation in this country. Bottom line, everywhere on the planet. So you look at 10-year note yields in China, 1.89. In Japan, they're two handles. In Germany, two handles. Even things like South Korea and France are 3% or lower. In the US, the 10-year note's 4.18. But then let's remember, it's a stated goal of the Trump administration to get interest rates and yields and mortgage rates lower. And it's a stated goal to get crude oil lower. There's one simplistic way to do that can happen overnight and really help them in the mid-curve election, the mid-term elections. And if the stock market just gives back some of its gains, maybe it drops 10, 15%. It's still up on the year. That would take away all the excesses. I think let's put it this way, if the S&P 500 dropped 20% and stayed down, that bond yield right now, which was 4% a few weeks ago, that's been resistance in bonds, 4% in yield, and 4% has been support in the 10-year note. I think that bond yield will drop to a two handle if the U.S. stock market were to drop to 20%, which would mean it's still up on a 10, 25, 3-year basis. That's how extreme we are. And to me, that's the bottom line. But it's their stated goal. But the key thing is this human being so emboldened by the stock market. Every time you hear more tariffs, part of the stock market is driving that. And remember the number one, remember it was April 9th when he pulled back and when we were pushing on the tariffs hard, he said, oh, we'll give you 90 days. That was the day the stock market put in slow. So what controls him? And so it's a unique thing, but we're at that stage now. It is the economy more so than almost any other measure and reading you're going to see.
Yeah. But you think, obviously, I'm not challenging you on this, but I do want to
No,
question and
please.
probe a little bit more on this.
Yeah.
When you say that people will rush into the bonds, let's say, for example, we saw that, I think it was in 2022 or 2023, where we saw people did not actually rush into bonds when there was a drop. And in fact, even with central banks buying gold, gold has been steadily up. People did not see bonds as a safe trade anymore, especially after the US was, I don't know, they kind of frozen the Russian assets and all of that. That was the first time in history that people didn't rush back into bonds. So, what is your central thesis around if the share market drops, why would people rush into the long end of the curve?
Well, it hasn't dropped and stayed down really decently since 2008. And that was also a short-term because we pumped so much money into the system. And then in 2020, we pumped so much money into the system. 21, we created the inflation we hadn't seen in 40 years. Um, that is so we reached potentially the end game. So the bottom line is the stock market has stayed resilient, and it's been the buy the dip mentality. It's not going to end until it ends. And so let's look at key things that's happening in the rest of the world. Like I mentioned, China is running massive debts to GDP. It's running fiscal uh, significant pumps in money supply, by some measures double what's in the U.S. And its 10-year yield right now is I guess is 1.86. In Japan, 200% debt to GDP, massive fiscal deficits. Its 10-year yields 1.64. I think we're going that way. It's that turning Japanese factor. And the key thing that's holding everything back, again, this is why I have to narrow back to U.S. stock market. So also the key thing I love, Farsi, is we need to push back. You need to push back because we had to discuss this because it's like I said, I've been wrong for 2 years on this. I just recently heard a podcast with Luke Gorman. He thinks bond yields are going to keep going up. The problem is if we keep that 30-year above 5%, it's starting to be a drag on everything in the U.S. that might bring it all back down. And if anything that takes U.S. stock market to go down is the deflationary forces because it's so expensive, which will kick in eventually. So, we're supposed to be buying when they're crying. Now, there's a consensus against Treasuries, which is perfect. You're supposed to be selling when you're yelling. There's a complete consensus. All this money flowing into cryptos and the stock market. Then just pointed out it's time to maybe go the other way, and gold's telling me that.
Yeah. So can I just reframe your thesis? So you think obviously Bitcoin and all cryptocurrencies are in a frenzy and a bubble, so that could burst. The stock market comes off for about 20 odd percent, which is again, you're thinking the S&Ps and the Nasdaqs or even the Dow. And because of that, people flight to safety would be in bonds and gold, those two assets.
Well, that's the actual money. It's more the number one force, the number one factor in long-term U.S. Treasury bond yields are inflation and inflation expectations. And so it's not so much the flow of the money, it's so much if the stock market goes down, that's its severe deflationary forces. There'll be by default no other place to go. So I'm not worried about the money flowing. I'm just worrying about when you have, and it's always the way it's happened. I mean, PPI in China is running almost minus 3%, but inflation in this country is still running 3%. I fully expect after reaching that around 10%, we're going to have periods when it's going to be minus 3%. That's not profound to say that. It's happened many times in history, but we still haven't got there. We're still running plus 3%. Part of the reason is because the stock market is just so resilient. Finally, Chairman Powell hinted at the elephant in the room.
Yeah. But let's say, for example, this plays out, the deflation theory plays out, and we do go to war next year. Aren't most governments going to throw a lot of money? Like Europe's also,
Exactly.
I don't know, spending about 5% of GDP. Let's say America's going to start pumping money, and a wartime economy is inflationary. So you're saying get into the bonds with a 5% coupon early on in the piece. So then even if inflation takes off, you're better off. Is that
Well,
what
I
you're
don't expect inflation to take off. I expect to continue lower to head towards deflation. And the number one factor, so I look,
how long will the deflation go on for?
well, we pumped a lot of money into the system in 2008 and 2020. And I pointed out Japan took about 30 years. Okay. China is in the middle of it right now. There's one of the best trades the last 5 years in China was to buy the long bond. It's jumped from like 3 to 4% to drop to 1.6 recently. Now it's 1.89 or 86. Yeah, and they're pumping a lot of money in the system. That money chases the deflation. It's a response too. And this is one thing I do enjoy when people forget about is um, the biggest what ended the deflation of the Great Depression was when FDR took the U.S. off the gold standard in 1933. That was March. That was it. That bottomed the stock market. and it was ended the deflation. But it took a severe force. It took, initially stock market to go down 90%. Let's not expect the iteration that needs to precede that money pump. So another good friend of mine, Larry Lepard, wrote the book The Big Print. I love that book. It's great. The problem is he should have published it in 2019, because we've had the big print. I point out in commodities, most of them, with the exception of copper and copper and gold and some of the other metals, we're in that deflationary cycle from the inflation. And we're going to learn that lesson. One thing that was a major, major contention of the last election was inflation. If there's anything people hate a lot, it's inflation. And I think we have learned the lessons of pumping too much money in the system, and getting the inflation. We got 10%. We pumped too much money in the system. There was other reasons too. And so it's one iteration. It's the first bridge that matters.
And this was the funny thing during after COVID. They said, "Oh, we've never had inflation. We pumped so much money in the system before. We never had inflation before." But obviously, this time it was direct to the consumer, handouts, and obviously there was also shutting down supply chains, which was it was a demand pull, but it was a cost push in a kind of way, or just the supply chains being locked up, which caused the inflation. So with them now, again, the reason I'm asking you this is because I want to go a little bit deeper. Do you think, so if you're going to deflation and the central bank the Federal Reserve keeps dropping interest rates, just like every other central bank has, they think that by dropping interest rates, people will borrow more. This is the same logic they use even after the global financial crisis, when Europe, Japan, Switzerland went into negative interest rates, right? But they did not see inflation because people didn't borrow money.
Are they borrowing in China? Now, it's a whole different example, partly because their assets have dropped so much. Most notably, some of my colleagues I spoke to, their real estate assets have dropped so much, and money just leaves the system. And yeah, you might have to borrow to survive, sure, but then of course you get tightening the lending standards. But it depends how much you want to get in the weeds. The bottom line is, it's the complete, utter, unprecedented dependence on risk assets that are the most expensive in history to keep going up, to keep the system inflated, to keep it going, that I think will lead to that next recession, deflationary recession. And fully expect the Fed to ease a lot in that environment. But I expect them to chase it. Right now, they're trying to front run a little bit, like Steve Moran said, how bad things might get. Like, okay, then maybe we should start worrying. But it's the bottom line. As long as the stock market is stable and goes up, we're fine.
Yeah. So no, I agree with you, but I kept pushing on that because the whole point I've tried to make on my previous interviews also is the central banks have tried this same crazy policy of printing too much money too many times, and now they're out of kicks. This time when they print too much money, they can't revive the economy the way they thought they could, and they can't inflate those prices away because as you just said, when deflation kicks in and the human mentality is, oh, there's artificial intelligence, I might not have a job in 6 months' time. I need to repair my balance sheet because I'm over leveraged and the stock market's taking 30% off. People aren't going out there and spending money into the economy or betting on risk assets. And this is exactly where the reason I kept on pushing on that was because I know risk assets are going to come off. And I think gold is going to be one of the safest plays on the other end of this. Whether it's inflation, hyperinflation, or deflation, gold will be one of those assets that actually benefit out of this. Your view on gold. Now let's go there because I know you love gold. And obviously I know you look at gold with different ratios. Please, all yours.
So let's start with the S&P 500 divided by gold has dropped down to 1.76 ounces of gold per one S&P 500. The high during the biggest money pump in history is 2.6. The historical average is 1. Now, over time, the total return of the S&P 500 divided by gold always goes up, but it's been stagnant for 28 years now. Okay, now there's fluctuations in there. That's the total return, and it should. Human nature, human ingenuity, earnings should always beat the stupid rock. The problem is, I just point out it's not happening lately. So here's my shorter term view for gold. First, I want to mention the key thing I'm worried about, and I've been wrong about for 2 years. Gold's getting really stretched. it's stuck between, we talk about dollars, between 3,500, very good support, which was the peak in April, and 4,000, which is very good resistance. Now, yes, it's psychological, but all my analysis I look at, if gold gets to 4,000 anytime soon, it's very unlikely to happen without a catalyst from the stock market, from deflation of the stock market going down. That's just the way it's always happened in history, to get that stretch versus a 60-month, 200-week, 300-week moving average. I mean, it's just a good bull market that's stretched. It's a great sign, and central banks are buying it. That makes sense. So I think it's stuck between a very narrow range. But the key thing I want to remember of gold, which is probably why I think the next big trade is U.S. Treasury long bonds, is I've been able to go back 50 years. And you have to go back to 1983, the last time Treasury bond prices were this cheap versus gold, versus the gold price. 1983. I was 20. I remember that. I remember that inflation well. But that's the point, that they're just so cheap and gold's getting so expensive. So if the stock market drops, and we all know what happened in 2008, gold was up 30% in 2007. Stock market dropped, gold pulled back 30%, and then continued going higher. This is 2008, I mean, because it had that big. Now we have in front running. I think gold's front running it. So I think what might happen is, when we do get this correction in the equity market, sure, gold might come under pressure first, but people are going to realize the deflation, and they realize the cheapest asset on the planet is one they've hated for a couple of years. Will be that long bond that was 5% last week or a couple of weeks ago, might easily go to 2%, what it's doing in Japan and China. Now, I do want people push back on that and say, oh, you can't do that, Mike. What's happening in the rest of the world? Like you mentioned, Europe, Germany. 50% of Germany's GDP was dependent on exports, yet they make internal combustion engines, and you can buy BYD that's half the price and twice as efficient. It's just a better vehicle. Obviously, I've been driving my EV is 11 years old. The world's changing fast. Again, that book, Price of Tomorrow by Jeff Booth, rapidly advancing technology. Yeah, and then there's also, the whole joke is, if you ever want to see major technology in weapons, they all kind of German background. We're seeing weapons mattering nowadays. So there's a Cold War, the war's hot. There's a major paradigm shift in technology, and the largest economy, I think a third to fourth largest economy in the planet's got a big problem, Germany. The largest economy in the world, China's already have that deflationary force, and they can't just export as much as they could anymore. They're getting shut down. And then we have Japan in there having issues, now have to pay those tariffs to U.S. automobile makers. So the whole world got used to this world order of being able to export to the U.S. and depend on U.S. for defense. Poof, Trump just shut that off.
Yeah, yeah. Can I test a theory? And you tell me what's happening. I also think the Dow is going up. No, not the Nasdaq, but the Dow is going up a lot because of global capital rushing into the USA, because of the brain dead stuff that politicians are doing in Europe. European capital doesn't want to sit in Europe anymore. Obviously, we had the issue with the UK guilds last time round. We've seen recently what France and the UK have said, we might have to go to the IMF for a handout. People are losing trust in governments and government bonds also. So the pension funds, some of the sovereign funds, are actually moving either into treasuries or the Dow, or gold is also moving to the US. Can you pull any threads or pick any problems with my theory of why the money is rushing to the US? And obviously, eventually the US dollar, I do agree with Luke Groman as well, and even the dollar milkshake theory, but I think the US dollar will spike, because when global capital wants to rush in, they will rush into the US markets initially.
So I think it's best for our audience that we disagree sometimes, because it helps them decide, and we do it cordially. But I agree with you on that, Fars. And partly you just look at what's happening is the dollar is the least worst of all the currencies. But on a scale of 1 to 10, there's nothing better than the dollar, particularly right now when that 10, you're still getting a 4 handle. In Germany, you're getting the 2 handle. And then, most Asian countries, you're getting 2 handles on those 10 years. Now, it's obviously short term that matters more. But let's also remember, anytime there's a volatility pickup of global issues, obviously you go to the dollar. And I mean, it's just a fact of the protection. I mean, there's a war going on in Europe and every day. And I love that quote from Tusk, the prime minister of Poland. You probably heard it. It does not make sense that 300 million Americans should be defending 600 million Europeans from 140 million Russians. And So it kind of shows the value of the good old buck. And yeah, I'm American, I'm biased, but I focus on a global basis. The key thing that also, let's point out what's really driven the dollar since 2009, the bottom. If you overlay the U.S. this S&P 500 divided by the MSCI ex-U.S. index, basically the U.S. stock market versus the rest of the world, it's the same chart as the dollar, and they both have started ticking down this year. But if we have some discombobulation, some disruptions in markets where the stock market goes down in the U.S., I agree with you. I think the fight will be the Treasuries, and they're expensive. I mean, the prices are cheap, the yields are high, in a stagnant environment. In a deflationary environment, they're extraordinary. There's got to be a readjustment. And then who's going to have a better? I mean, yeah, I always like when people push back on, obviously the U.S. has issues with debt to GDP, but it's only 130%. It's 300% in China, and their yields are 200 basis below, and many other countries. It's who's going to fix it. So here's another thing that people get about the U.S. It's that natural self-correcting mechanism. I don't say it as a bias. It's just what happens. People got sick of Biden, poof, he's gone. People are going to get sick of Trump, and particularly if the things he are doing aren't working, poof, he's gone. And midterms come in almost a year. And by the end of his term, if what he's doing doesn't work out, he's gone forever. If they do work, if the tariffs do work and the U.S. economy is doing fine, that's going to set the tone for what FDR did. It set the tone for what he did for decades. But it'll correct rapidly. It's not perfect, but what country's better at doing it? We kill each other. If we don't kill each other, we'll be fine.
Yeah. And as you said, I think most outside commentators also keep commenting on the US having all these problems with 37 trillion. And I keep reminding them we live in a global economy. It is still the cleanest dirty shirt in the laundry. And at the end of the day, it is the global reserve currency. So when we have panic, everyone rushes to the US or on the US markets. Your view on the tariffs at all, Mike? Has it been a boon as everyone mentioned it was, or is it actually causing a recession? Is that what's causing the slowdown in the economy?
I'm glad you went, and I really enjoy speaking to you. First, let's put that 37 trillion in context. The U.S. stock market cap is 70 trillion. I love doing that when people worry about U.S. debt. I mean, compared to our stock market cap, it's almost a half. It's near the lowest in history versus stock market cap. So what's the problem? What's the sore thumb? U.S. stock market cap. So I'm glad you mentioned that. And that's stupid. We need to fix this. We need to stop spending like drunken sailors. Please, let's fix the system. At least Doge has tried. There's some attempts there. But the key thing way I want to describe tariffs is I got my MBA in, was it 92? 93. And I was going to school in the 90s. And I remember learning, I worked at Chicago Board of Trade during the day and went to night school at DePaul University in Chicago. It was the most intellectually, physically, mentally demanding thing ever. And you can't do it anymore because you can't work in trading bits. They don't exist. And going to good business school, it wasn't the best, it was good. And one thing I learned in business school was, how great free trade was. And one thing I learned being on the phones in the trading pits, and I was never in the pit. I was talking to international customers, people like you. I was in Chicago and I was working night desks in London. The last thing I learned from these really smart people is, free trade's great as long as you can run a surplus with the U.S. And that's what happened. And that's what Trump's fixing. So another book I'll mention is No Trade is Free by Robert Lighthizer. I read that book the day Trump was elected. I mean, I downloaded it and listened to it. I mean, in Miami, I do a lot of bike riding. It's how I commute. And that book nailed it. Lighthizer pointed out if he gets reelected, then this is what's going to happen. And it's exactly the way it's happened. A little more extreme than I thought. But we remember have to think about this emboldened human being was in exile for 4 years and he thought he was toast and he got a second chance. He's not gonna mess it up. And that was my bias. Another key book that helped me define what's going to happen with Mr. Trump was another book called At War with Ourselves by General McMaster. He was President Trump's security advisor. And his quote was, if he gets reelected, he's going to bring on nothing but complete loyalists, which I don't agree with. You need people to counteract you, like you and I are disagreeing a little bit, but that's exactly what he's done. But the key thing that's going to happen with tariffs, here's what I like about them. And what I think is wonderful is at least we're willing to try it by readjusting something I started complaining about 30 years ago, to readjust this imbalance. Like just the fact I used to complain about years ago, why does this country of France charge 20% tariffs on U.S. wine and we charge them zero? Why does the continent of Europe charge 10% on U.S. autos and we charge them zero for decades? I never thought that was appropriate. And you also look at what's the most demand pull significant market on the planet. It's the U.S. I mean, and I agree with what Trump says. If you want to sell the U.S., you should. There's no such thing as free trade with the U.S. if there's no tariffs, because we're such a demand pull economy. The fair is that the access we have to your country, or typically another country, which is typically a fraction of what the U.S. has demand pull, is some sort of tariff. So here's the way I look at it: is if it works out, it's going to set the tone for world order forever. And it's going to help do what Trump says. It's going to bring back some of the things that, and it left the US. I mean, I'm from the Rust Belt, so I get it. I've seen it happen. If it doesn't work out, it's not going to happen. But here's the number one thing that happens for markets is corporate earnings and tariffs. So you got to ask yourself, is it's really bad for corporate earnings? Why would a CEO who's in the heartland, which is where I'm from, I've been in Miami and East Coast the last 3 decades, shut down a plant that he knows is going to put out his friends out of business and people he's known forever to offshore and bring in cheap stuff from any other part of the world? Why would he do that, or she do that? For one key reason: profits. And what's going to hurt eventually is earnings and profit. It hasn't showed up at all yet. It's all about the Mag 7. But I look at it this way: if you want to replicate the S&P 500, you don't. There's only like 20 stocks you have to buy or sell, and that's all the Mag 7. To me, that's what's going to kick in, and we might see that by the end of the year. And it's why that stock market has to go up, and why it's worried it's more likely to go down.
Yeah, the tariffs might help in that sense. I saw an article the other day. I think it was Australia Post, because I still have bank accounts in Australia. I've lived in New Zealand and Australia. The Australia Post actually stopped posting anything to the US and some other countries as well, because they didn't know how much the product was going to cost, because he's constantly changing the rules on the tariff, or he's changing percentages, or pushing it out by 90 days. I totally agree with you with the whole concept of, if it's got to be free trade, it should be free on both sides rather than just one country paying the bill for it. But do you think they will let him succeed, his tariffs succeed? Because again, there's a lot, as you said, US is a self-correcting mechanism, but they might say Trump's only there for 4 years, 1 year's done and dusted. We have midterms coming up. Do they throw something in a wrench in the playing field, so to speak?
They could. What's recall? It would became. It was the wonderful thing about, love him or hate him, Mr. Trump, but he points out some things that the world is just willing to face, that have become completely bipartisan in this country, pushing back on China. I mean, the Biden instituted 100% tariffs on China EVs well before Trump came in. So that's my point: is if it succeeds, it'll trickle down, it'll just stay. And they can push back on it all. The number one thing to think about in this case, Tarzan, I think, is the uncertainty of what's happening. Despite this significant discombobulating uncertainty, the U.S. stock market's still on a tear. My fear is it still hasn't priced in what could happen with this uncertainty and this shift in the world order. And it's wonderful it hasn't yet. I still think it will. And that's where I think gold is. So to me, that's the bottom line, what matters for markets. But the psychology of it is, once you start getting that revenue from tariffs and its economies, my point is, if the stock market stays strong, there's no reason to change anything. So that's the point. And it's not, they're going to be worse and worse and worse until the stock market tells them to stop. It's that type of Faustian bargain. And that's what I think that, like, the cryptos that made with Mr. Trump was like a Faustian bargain, and I'm concerned about. And that's why I think gold loves. And that's another thing I went in with. Every time Mr. Trump speaks, I think the gold market smiles, because and I knew that you'd get to, because you get this, and just by your culture and where you're from, you get it. Everybody is like, this guy is so discombobulating. He's shifting the world order. And what's my safety valve? Yeah, I'll go buy some of that rock. And I think gold just loves him.
The shiny metal, right? When you said changing world order, could we just go there for a second? What do you think with the unilateral world and the bilateral or the multilateral talk with the BRICS impact? How do you see that playing out?
Oh, I so enjoy it. I mean, started by Mr. O'Neill of Goldman Sachs, but Brazil is way down here in South America. Russia is way up here in Europe. India is in Asia, and China is all, right next to each other. And they've been friends too long in history. I mean, it's just, and they have major issues with currencies. And yeah, it's entertaining that they might have the one kind of currency block. I'm like, yeah, good luck with that one. The key thing is, it's the benefit of where US is. Canada up on the upside, both oceans protecting us, Mexico on the downside. And if we don't mess it up, it's just such an advantage. It's like when the European settlers first came over and plowed the lands and saw the the grassy fields of the Midwest, their tongues just drop. Oh my gosh, you can't beat that. And if we don't mess it up politically, there's no comparison. So also a key thing I want to tilt over is what's happening organically. Cryptocurrencies. I touched on this earlier. I was in Hong Kong in 2018. It was a significant bear market. That's right around the time I saw Bitcoin was at 10,000. It would drop to zero. Again, it only went to 3. But there was one key bull market that was happening. The market cap of Tether is the most significant stablecoin, was $2 billion. Now it's about 170 billion. Total cryptocurrency market cap is around 300 billion. It's happening organically, and where people can finally, like an email, transmit dollars on there and be able to hold dollars on their phone, and not something that trades like Bitcoin. It's just getting there organically. So I look at the whole world with their eyes wide open, like, uh-oh, what are we going to do this? We have to instill our own central bank digital currencies, because the whole world is going to the dollar organically through cryptocurrencies. And finally, stuff I loved writing about 5-6 years ago when Trump was just not figuring out what's happening in this space. Finally, they figured it out. Nothing like technology and profits they figured out, yeah, maybe we should support this space, and because the dollar likes it. And by the way, all these crypto dollars and stablecoins are investing in treasuries. It was just fun to write about that, because knowing where we go. And that was one of the key things that made me really bullish in 2020. They hadn't figured out, even Biden hadn't figured out. And now they figured out, and it's all it's all priced in. But that's a key thing to think about in terms of anything now, is the whole world can get access to the dollar via stablecoins. Is the most significant bull market, and this technology is overwhelming. That's a big difference from, trying to buy Dogecoin at 23 cents, expecting to go to 40 cents.
At least it's got the backing of the U.S. government and the U.S. military, as
Now
they
it
say,
does.
right?
But it was fun to see that. It was fun to see that work out politically. Like, maybe they finally saw some of the stuff I was writing on the terminal. And I can't, take credit for that, but it was just so logical.
I have a theory behind the stablecoins and the Genius Act, if you don't mind me hearing out. You mentioned in the CBDC, most countries are trying a central bank digital currency model, and the US Constitution forbids the Federal Reserve to create a CBDC, direct to public currency. So they found a loophole around the CBDC model in the USA, and stablecoins is essentially a CBDC. It is a BDC, not a CBDC, right? Bank digital currency. And the other thing is, obviously, there weren't many people buying US treasuries. Obviously, Scott Bessent, just like Janet Yellen, had a problem. They were starting to shift it to the short end of the curve, because people were buying gold instead, or central banks were buying gold instead. Scott Bessent has a problem with people not buying the long end, and they have to keep rolling the debt. This is what I keep telling people. The whole US debt, or every government debt, is a Ponzi scheme, because they never, ever bloody pay it off. They just have to roll it over at the new interest rates, and it keeps going. I think US is still paying debt back from World War II, if I'm not mistaken, and then it takes an exponential effect. So they've obviously gone. Why did Trump flip-flop on the stablecoin? Because obviously it's backed by US treasuries. And this is one way of getting people to buy US treasuries or back the US treasuries. Yes, it helps other people in countries like Lebanon or war zones or in Africa, where they don't trust their governments even more than the US government. But they can use stable coins, and they can jump on a boat or a plane and get somewhere else. That was my thought. You want to tear it
Oh,
to
no, no,
shreds, or you want to go
no,
anywhere
please.
there?
I guess it's more fun when we disagree, because I just learned from you, and I hope our audience learns from both of us. I agree with you. And it's the key thing I think about it. So there's 130 currencies in the world. There's really 5 that really matter, the big ones. I mean, the big ones. Every one of those is becoming, and there used to be many more, they're becoming more redundant because of stablecoins, crypto dollars. And that's why I look at every other country as like, oh boy, what are we going to do about this? Trump figured it out. They invest in treasuries. Yeah, I get the part about not paying them off, but I've been trading treasuries for 40 years. And I've just never seen this type of period where the yields can stay this wrong. But there's a good reason for it. I've never seen a period where the stock market staying this expensive. And so maybe it's just a trade that's going to last a few years, but I fully expect that these bonds I'm looking at 5%, they're going to go closer to 2 or 3. And if they stay above 5, that's going to make the stock market goes down. But overall, again, this is part of that Faustian bargain by Trump tilting. It was July last year, and he presented at the Bitcoin 2024 thing that Bitcoin's dropped the low since then. It's about 15. He pointed out how great it was and cryptos were. He and the crypto people helped him get elected. I mean, they brought in a lot of money, just like bringing in Elon Musk. It brought in a lot of money. And at the same time, one of the key issues was Biden pushing back on this technology, which is just silly. It was just dumb. But okay, we're past that stage, and it's good to see we flipped. But what did it take? You had to hammer people a little bit, as Nishi says, if it doesn't kill you, it makes you stronger.
Yeah. One last question. Obviously, you love your gold. I just want to ask you this because in some of your charts, I see you comparing either two commodities or a currency. How do you use commodity ratios to understand if a commodity is well priced, underpriced, or highly priced, richly priced?
Let's use one example right now, the gold to silver ratio, which is the most relevant on the planet, because comparing gold to any other commodity, it's not apples to apples, but silver is as close as you can get to that precious metal. It reached 105 in April, right when everything hit the fan. And silver is just incredibly cheap. 105, and historically, it's been closer to, when Sir Isaac Newton became chancellor of the mint in England in 1600s. It was 16. It was 105. That was just two example. That was a buy signal on silver. It was around 30, and now as we speak, it's around 46. The opposite's happening now. The ratio between silver and the gold to silver ratio, that cross, has been basically hovering between. The bell curve has been between 80 and 100. I mean, the 62% of what's really for like 5 years. And then we have some wings above 105 or really below 80, around 75. Right now, it's about 82, 81. It's getting to a sign where you're supposed to be starting to lighten up on your gold to silver ratio and think it's supposed to bottom, because for it to really go down lower from here, you need that global economic pickup. You need copper to be breaking out. You need the stock market to take off and demand pull forces to kick on a global basis. Yet it's the opposite that's really tilting. So I'm looking at near the lower in the range. It's giving me signals now that silver's getting expensive, and silver's near 50. It's probably going to peak there and maybe print a new high, but we know what happens every time in history it's gotten there. At the same time, gold as we speak, is $3,380. It's really pushing up good resistance. That's one key measure I really watch. But if you look at every commodity, Bloomberg Commodity Index divided by gold, it's the lowest ever. You look at copper versus gold, the amount of ounces of copper for one, the pounds of copper for 1 ounce of gold was almost about 800 recently. That's about the highest ever. That's never happened without a significant recession. The signals are very, very rare. We're living in, may you live in interesting times. We are. So that's kind of the way I watch them. That's one specific one I've been watching recently. And so I'll end with this. That was gold, silver. One of my favorites that I've been watching is gold, Bitcoin. And so Bitcoin gold, ounces of gold per one Bitcoin. Right now, it's about, what is we 29 um, ounces of gold per one Bitcoin. It's been stuck in a range. That same level was printed. It's the same level as 2021. That's a really bad sign for this highly volatile risk asset. Bitcoin trades 3 times the volatility of gold. It's way underperforming gold this year. But at 29, it's stuck in a range. The high for the year is 36. The all-time high was 40 right after Trump got elected. It's just me reverting back. So I look at it, it gets near 25. It's supposed to probably be maybe overweighting some of that Bitcoin. It's near the lower in the range. But at 35 recently, you were supposed to be selling that Bitcoin and buying gold. Now we're nearing in the range. It gives you good signals as a trader. I don't trade anymore, but I'm sure people watching it just shows you where you should look to be overweight or underweight.
Yeah, switching from one asset class to the other asset class, depending on these kind of ratios. I've also heard one in the past where gold to S&P is 1 to 1, and I've heard some people say this time it might even go to 0.5 to 1. Any thoughts on that, and how would that come over? Is the S&P going down or the gold going quite a lot higher?
So I'm afraid. I think they're going. Well, historically, they've gone to 1 to 1. The ounces of gold per one S&P 500 historically, we can go back 100 years, is really averaged around 1 to 1. The difference is if you take total return at S&P, it always outperforms gold. So we just use as an indication the spot index, and of course the yields now in S&P are the lowest in 100 years. I'm sorry, 20 years. It's like, what's the dividend yield? 1.1 or so. Take out the 10-year note yield, it's negative. So S&P is just so expensive, and that's my key thing is it's tilting down versus gold. It's had that lower, the tilt down is very similar to 71, 72, 73, right? When Nixon took us off the gold standard, it pumped up the same level and rolled over. It looks very similar now, and it's one of my key ratios I like to watch. I expect to continue to go lower, and a good place for it to meet is around 4,000, which would be horrible for the S&P 500, but I hate to say it right now, it's right about 6666 S&P 500. That's not a good sign. I remember it bottomed at 666 in 2009, but it's going back to 1-1. I think it's just a question of time. And The bottom line for everything is simple little signals. If we get a little pickup in U.S. stock market volatility, the lowest in 5 years, 60-day basis, that might be the trigger for these things to continue. But overall, S&P 500 falling versus gold is not a good sign, and that's what's happening so far this year.
Yeah. So did you say you think it tops off at? You said 4,000 in there. So are you saying gold tops off at 4,000?
So that's the key thing. Maybe they meet. The question is where they meet. I've been thinking this for a while. I've been wrong. Maybe they meet at 5,000. Maybe they meet at 6,000. But gold getting to 4,000 with the S&P going up is a very rare thing. You need to have, I think, more oomph from that gold S&P 5 ratio tilting the right way, and so maybe gold's just front running, but that's where you kind of gets kind of dicey. I'm still bullish gold, but it's just way overdone here. It's so expensive. The key thing I like to mention about gold, I watch. I don't want to go too long. I keep a very close eye on what really signs are overbought, and typically it's speculative futures can really give you an idea of being overbought. Right now, total open interest on the COMEX of net longs and our hedge funds are around 30%. Last year's high was 45% or so. They were much more net long last year. So those potential sell stops are not there. And the ETFs are just, we had 4 years of outflows. It flipped into significant inflows this year. Yet they're still lagging the price of gold. So bottom line, what's really driving gold are central banks.
Central banks, yeah, and geopolitics, I reckon. You've been pretty grand with your time, and obviously, I know it's Friday afternoon in Florida, so you might want to call it a day as well. So we start getting towards the end. I'll just do a quick fire round. I might know some of your answers to these, anyways, um, but we'll ask again, anyways. If you were to put your money right now, would it be in Bitcoin or gold?
I can't give investment advice. I think gold's going to continue outperforming.
And between gold and silver?
Yeah. I think gold's going to outperform silver as we get to that gold silver ratio near the lower end of range around 80. I think it's potentially going to go back to near 100.
Okay. And do you prefer, if you were to hold on to, would you hold on to stable coins or cash?
Well, the things that's the thing right now. Stablecoins don't pay. They're going to eventually figure out how to pay a money, be like a money market, and pay, that 4% you're getting in a T-bill. So that's the problem with holding it, because they're great for transmitting, transacting, and holding profits, but they're leaking over time. You're not getting your opportunity cost is bad. So cash at least gives you 4.5% in a money market. And here's the thing: the total money market assets in this country are around $7 trillion. People use that metric and say, oh, how high cash is as a relative to the stock market cap. That's 10%. In 2009, before the great crash, it was closer to 15%. So putting that in context. So now that's a key thing. I'm glad you mentioned the question, but we have to put it in context. Stablecoins don't pay interest yet, and they'll figure it out. Most of them don't.
And one of the other, I heard a Jim Rickards interview, I think about a week back, and he said, just like the FTX, there might be a bit of fraud going on in there. We don't know which company could be doing it because they don't have to prove anything anyways. At least $100 bill in your hand is $100 bill. And I think I've heard Trump is trying to also launch a $500 bill in the USA. Don't know when and if that comes about or not, but hey. Coming back to the questions, Mike, is it, if you were to, let's say you're investing your own portfolio, you don't give financial advice, and we don't on this channel either. Do you prefer commodities or the actual underlying mining shares of the commodities? Obviously, assuming good mining picks.
It's one thing I've really enjoyed about meeting you in our conversations. You obviously know markets very well. And historically, some of the worst investments are the actual physical commodity you have to pay for storage. Some of the best investments are equities um, that mine and produce those commodities, particularly in the elastic energies and grains. So overall, just the key thing I've always liked to point out, I encouraged our index team a long time ago to produce a Bloomberg All Metals Index, because the only commodities that really are worth typically holding the actual commodity over time are the metals. Gold's on the top because you don't have really, you can hold gold forever. It doesn't really cost you anything. Depends on where you store it on your body. Metals are so I've always looked at the best way to get exposure to commodities is the actual hold the metals, they're all metals, gold in there, and then the equities and virtually all the other equity and the other commodities. But if you roll that those futures over time, you got to pay storage. You can't get away from it in the long term. And let's say crude oil storage is like 8% a year, and storage and natural gas is what 20 to 30% a year. Grains 5 to 6 to 7%, and typically it's you want to be the equities, the producers.
Wasn't it the futures or the stories that caused crude oil to go negative territory in during COVID? Wasn't that the case where they just kind of, yeah.
Yeah. So like I was just on another call recently. If you take the most widely tracked energy ETF is XLE, and the most widely traded crude oil ETF is USO. You take XLE divided by USO, it's a bull market. It goes up over time, partly because you get those earnings, you have companies, you have human ingenuity, and the USO is rolling the futures. You have to pay the storage. It's only a physical commodity. The price of crude oil on the screen right now is $65. It first traded in 2005. Why? Because by natural, the key thing to remember about almost all commodities is by nature, they're deflationary. Humans create more with less every day with technology, with the exception of gold. Um, they almost always underperform money supply and inflation and trade down over time. And that's why I'll end with key fact. So I owned a farm in the Midwest, and the average acre of corn land in the US this year is going to produce about 185 bushels per acre. 50 years ago in the 70s, it was half that, was 90 bushels per acre. So that same acre of land and now has double the production of that same commodity. It's just rapidly advancing technology and humans advancing and harnessing energy in the land and making things better.
But that actually makes you realize, even though you've mentioned the Jeff book, his book as well about deflation, technology is deflationary. As you said, human ingenuity is deflationary. Everything makes the commodity prices go up, go down, but everything is still more expensive, which tells you the amount of inflation that's baked in the cake because of the monetary system and the amount of money being created by governments and central banks. Because your corn isn't cheaper now than it was 10 years back in the USA, I'm pretty sure. In fact, I give people in New Zealand an example saying that because in New Zealand and Australia, housing is seen as such a big boom place and the mentality is always invest in housing. And I say, look at a dozen eggs. If they cost you 50 cents and now they cost you $10 a dozen, you're only getting 12 eggs still. But as we said, it's deflationary, but it's the amount of money they've been creating that is causing the problem, right?
Well, also it's people forget about the carry. Um, like my mother's house, we're going to be potentially looking at selling it soon. There's a significant cost to carry in a piece of real estate. Not only the taxes, insurance, upkeep, cleaning, maintenance. It's very expensive. People forget about that sometimes. Yeah, but if you're living in a place, you need a place to live. There's a negative, very expensive cost to carry in any type of real estate and housing. And people forget that. Now, obviously, in real estate, I'm in the land of condos. They've gone up a lot in Florida in the last 10 years, but there's so have taxes. And that's where some of these financial assets that produce revenues and are wonderful, and now they're too expensive. So that's when I tilt over to what's kind of something I can just sit back and then clip my coupons and treasury bonds. But that's only because everything's so expensive. But that's the key thing. Remember, real estate is there's a significant cost to carry. And particularly if you're living in, it's great. But if you're renting it out or something, and then of course there's headaches. So
What is the US housing market doing out there? Because I've heard not good things. Is that true?
I hear that everywhere. Particularly the beta for the whole world and for the country is Florida, and Miami is peak, and everything's rolling over. Um, it's slowing down, I mean, as you'd expect, but it's the complete cycle. I mean, we just threw money at people, made them stay home. So what they do, they fixed their homes and bought homes during COVID, and now we're getting towards this cycle. So condos in Miami are rolling over, real estate's rolling over. It's becoming much more of a buyer's market, and we're overdue for that to last for a long time and stay that way. And interest rates are still high. They're improving a little bit, but it's just a normal cycle. Everybody expects it to happen, and it also depends on location. But overall, the macro I'm hearing everyone, me actually being in the market and looking, my wife and I are looking for property in certain places, is everything's rolling over and we're no hurry to buy. Here's the quote I've heard from a good friend of mine who just moved here from New York is, it's just consensus. Don't buy, rent, and enjoy it for a while.
Exactly. I don't catch a falling knife, as I tell people. If the market keeps dropping, just let it keep dropping. Don't put your hands in there. You've been gracious with your time, Mike. So I'll let you. I'm just in the end, we just let the audience get to know Mike a little bit. You've obviously mentioned quite a few good books in there. I will ask you to send me the names of most of them. But I ask this at the end anyway. So the book you would recommend to your friends most often. So even though you mentioned all of these books, whether it is to your family or your friends, one book that you would definitely recommend.
Yes, I've become friends with, that's a hard one, but I have become friends with Jeff Booth, and he really shaped my bullishness on Bitcoin and my bearishness on China. And that book was The Price of Tomorrow. He wrote it a few years ago. I suggest it for everyone. And the reason I want to mention is just as we speak, Zhao, I don't know if I can really pronounce it, just came out with a copycat iPhone for $632. The amount of rapidly advancing deflationary technology coming out of China, supported by the government, is overwhelming. And I think the Mag 7 profit machine is going to have problems as normalization kicks in. So I think that book is worthy for everyone to take a look at. It's the premise is don't underestimate technology. So, I mean, I remember being in high school, things like these were a dream. Reason I mentioned high school is today I saw that there was the anniversary of John Bonham dying, who was the drummer for Led Zeppelin. I remember being depressed in 1980 in high school when he passed on, but they moved on. But Led Zeppelin still did okay.
Thanks for that book. I've read it as well, and it's not even that thick, to be quite honest. And it is brilliant. It kind of tells you how everything plays out over the next few years. If you weren't in finance, Mike, where would you have been?
I don't know. It's a good point. Well, I have an Irish name, so it may have been plumber. And in the U.S., there's Irish is oftentimes associated with plumbing. It's just never hear Michael Flatley. You never hear everybody knows Michael Flatley of Riverdance. When I was living in Chicago, I was living with my parents for a while. Him and his father came over and actually did some plumbing in our house. And I shook his hand. This is before he became famous. So maybe I could have been a plumber. I don't know. But the thing that happened for me is I was always interested in money and markets and global. And having grown up about 30 miles south of the Chicago Board of Trade, it was just a natural fit. It was lucky. I was lucky to get a job there out of college. Didn't want to work in an office, and it shaped my life. I like to say I've got numerous graduate degrees, but what I learned in there in 5 years is equivalent of many graduate degrees. It's just so intellectually stimulating if you used it right. A lot of people abused it. It was just a great way to learn markets and people and human nature.
Or any character trait that you respect most in other people?
Content of character from Martin Luther King Jr. One thing I learned on Wall Street, I enjoyed in my 3 decades on Wall Street, is it's a very neutral place as far as religion, color, nationality, sexuality. It's very much about we are here to make money together. And please don't, we don't, get your religious beliefs as everything, but the key thing I think most people believe in is karma. And that is, things come around to those who are not so pleasant. So karma. But no, my main is content of character. You can really Martin Luther King nailed that one.
Okay. Now, the last question. Obviously, I run a financial consultancy called Success Simplified. So I ask most of my guests this: how does Mike McGlone define success?
Oh well, happiness. I mean, obviously, it's an American thing to be rich. I used to joke around. Some of the wealthiest people I've covered and spoke to, and being on Wall Street forever, are some of the unhappiest. And just
They're
I'm
miserable
very
sometimes.
Yeah, as you see it, yeah, and it's especially if they're born with money. Sometimes they're the most miserable, so I don't have that problem. But no, I'm very lucky in that case. And well, I'm very married for decades and have had plenty of children, so we're good.
Yeah, thank you for that. Hey, anything you think I might have missed that you want the audience to know or is urgent? Anything at all?
No, this is great. I'm looking forward to our next conversation. To see how things pan out, because I think these next 3 months will be telling this fourth quarter, and we'll see if I'm thrown down the mat and stopped out, or if I'm right. If I'm right, it's going to be scary.
Yeah, I think you'll be right. I see deflation in the short term, anyways. Where can our listeners find out more about you, Mike?
Well, on your show, thank you for having me on the Bloomberg Terminal. And I do post on X at Mike McGlone 11, on LinkedIn, Senior Commodity Strategist. And if anybody wants to reach out on LinkedIn, send me your email, and I'm happy to put them on my distribution list. I really appreciate meeting you and speaking to you. I'm looking forward to our next conversation.
The pleasure is all mine, Mike. It's been a great pleasure. Thanks for your time.